is that Jeremy Leaf and I had a conversation about 2 months ago now, following an article that we read that was talking about the effect of changing GDVs and changing residential and commercial values and the effect on that. So we were both in the same opinion that we were both quite surprised how sort of little a change in GDP can have such a dramatic effect in different places of the country and in different types of development. But we realized that we can debate this till the cows come home, but until we actually get some official perspective, some proper research, and those who spend their days doing what we were talking about inside and out, that we would really just be drawing a blank conclusion. So we're very, very lucky to have some fantastic contributors, Mr. John Neal from JLL, Lucy Greenwood from Savills, and Rupert Drive from CBRE, who are going to be following Jeremy's lead today. I'm going to disappear, let you guys carry on the discussion. Thank you very much all for joining us today. We're really looking forward to the debate. And Jeremy, I'll hand over to you.
Lovely, Alex. Thank you very much indeed. Very much looking forward to this afternoon. I have the dubious pleasure of hosting this rabble, but hopefully I'll knock them into shape. But we have, joking apart, some esteemed panelists today, and it's a particularly auspicious day. The Chancellor has made his statement, and that's very interesting for the market. And we want to look at particularly what impact that's going to have on the market, particularly the residential market. And our panelists will be looking at their view of what's happening, what's likely to happen, what has happened in the past, and in particularly, or just a little bit briefly about myself. I am a chartered surveyor and run my own practice for over 30 years. I'm involved mainly in investment development work, residential and commercial. And I was a former chairman of the RICS residential faculty. So I've always had an interest in this field, and I'm particularly pleased we've managed to get these three panelists together and from their busy schedules. First of all, we'll be kicking off with Lucy Greenwood from Savills. She will tell us her views of the market. We're particularly lucky as well. As I said, it's a good day because Savills' report into land and development is coming out today. So that is going to be hot from the press, and hopefully Lucy will be sharing some of that with us. And also then we've got John Neal from JLL, Head of Research there, and then Rupert Driver from CBRE. But I introduce them individually in a moment. But particularly, I want to find out from them about, as Alex alluded to, the stress testing of the market, what's actually happening there, how are we to really value land in the current circumstances, what should be taken into account, what is happening, are we about to suffer the worst recession of the world's wealthiest countries, or are we embarked on a V-shaped recovery, as Andy Haldane from the Bank of England said the other day. One thing is for sure, things aren't what they were, we know that, and I read today as well that Zoopla stated that 50% of house hunters have changed their priorities. So of course we have to reflect on that too, and how that's going to impact on our decision making. Nothing has changed really. We've got to be even more careful when we're buying land or advising clients or making judgments, that's for sure. Anyway, so let's get on with our presentations. Lucy, first of all, Dr. Lucy Greenwood is a director within the residential research consultancy team at Savills. She joined in 2013, specializes in UK-wide development, and spends her time mostly working on bespoke strategic development investment reports for a wide range of clients. What I'm particularly interested to hear from her is what really makes her stand up when she gets particular research. What makes her really get off her chair and say, well, what's happening here? Is there a change in the market? That's what I want to know. And also how she considers absorption rates on sites and assesses a suitable mix of developments when advising clients. That's something that's particularly interesting to me and hopefully to you guys. So over to Lucy, and for a few minutes, then we'll have chance for questions later. Thank you.
Brilliant. Well, thank you very much, Jeremy. So as I've only got a couple of minutes as an intro before we get into the discussion, I've shared my screen now, so hopefully you will be able to see what I can share with you, and do make it larger to be able to see more clearly. So what's going on in the market at the moment? Well, obviously everyone's able to kind of pick up on the news and it can't help but hear about what's happening in the property market to some degree. But let's get under the bonnet and see what's actually happening in terms of some of the numbers. And what has been happening to house sales, and where do we think pricing and transactions are going? Well, if we look at the number of sales agreed over the last sort of 6 months to a year or so, and compare that month by month, you can really see how much obviously we were hit in April and May in terms of the number of sales that were able to happen across the country. But if we look at how it's recovered since, actually it's been quite a sharp comeback and much more of a bounce back than we might have imagined. A lot of that pent up demand really getting out there and able to start moving and making those offers and getting their properties over the line in terms of selling them and purchasing them. So it's really since the beginning of June that we've seen levels back to where they were last year, and now running at almost 30% above where those levels were last year. So the question is of how long is this going to last for, which is a challenge for us all. And actually today's announcement from the stamp duty changes may mean that actually they were able to continue to be at these levels for longer than they would have been otherwise, particularly supporting the bottom end of the market up to 500,000, but actually helping the whole market, whether you're an investor, overseas buyer, or a UK purchaser of your own home. So what factors have been affecting what people want? Well, we've been hearing from Jeremy about what Zoopla have said in terms of people changing their preferences. We did a survey early on in lockdown seeing that people wanted extra space. So 44% saying they wanted extra space in their home for able to work or otherwise. 49% more likely to want to work at home in the future. 48% saying that Wi-Fi was increasingly more important, and 49% saying a garden was more important. Now, for those last two, even more so when you have children at home and you're the younger generation rather than more towards retirement. So what do we think is going to happen to house prices over the next 5 years now? Well, actually, we are forecasting falls for this year, and this doesn't take into consideration the stamp duty changes that we now know are in place. But we are expecting unemployment to grow towards the end of the year and the economy to be sort of that harder hit numbers to start coming through. So as a result of that, with furlough unwinding, if all of that comes to fruition, which is the baseline scenario from Oxford Economics, we are expecting house price falls. But we are expecting a bounce back when the economy recovers really into 2022 before getting back to kind of more normal levels of price growth in the longer term. So actually over the next 5 years, 15% growth is what we thought previously. And actually that's where we think we would be over that same period, just in a different shape. Transactions, obviously quite different. We expect to see a big fall this year because we just haven't had those sales that would have been during lockdown before it recovers and has a bounce back in 2022 as well. But what about the development market? How many homes are we building? Well, here we've got the NHBC data on how many homes we've been building. And April and May, those red bars for this year are far lower than they would be expected to be at this time of year, particularly, and June and July are years where normally we would be starting a lot more homes as well. So being able to get back to those levels is a struggle with the social distancing side. So what that mean? Well, we're actually expecting 33% fewer homes to be built this year before getting back towards the levels we were at last year. And then finally, on the land market, as Jeremy alluded to, we've just published a report today, which will be out later on our website. What we found from looking at the land market and monitoring our land agents and perceptions of the land market, but also what they're seeing in terms of land transactions that are happening, is that there are fewer deals being pushed over the line. There is less land on the market. but it is showing signs of picking up to some degree. Values have fallen at headline level by 1.1% for greenfield land across the UK in the last quarter, albeit that we have seen chips of more like 5% on deals that have been done in areas where there's more transactions happening. But overall, we've seen across the board, typically payments being extended. So instead of just deferring over a couple of years, they might be deferred over another year on from that. Also, just picking up on the survey that we've done of understanding what's going on in those markets and the difference between April and June, we can see that there are a variety of different measures here, and distressed sales are not something that is really happening yet, but there is appetite for them. Land deals, some have fallen through, but generally no one's seen anything of that scale at the moment. There are new sites coming to market, which is a big shift from what we'd seen in April, and those payment changes really being much more accentuated. Strategic land, and which is a market with a longer term perspective and less cash payment needed up front, has managed to actually stay pretty stable and continue in the same form that it would have done if we hadn't have had this situation with COVID. So that's all for me for now, but we'll be able to discuss more later.
That's lovely, Lucy. Thank you very much indeed. Very interesting and quite opportune, as you say, having your report coming out today. Hopefully there'll be one or two questions. I've certainly got one or two. Right, moving on to John. John Neal is head of UK research at JLL, responsible for the team's outputs across all commercial and residential property sectors, as well as providing advisory service to clients and publishing market-leading output. He's been involved in various specific studies in London recently as well. I'm particularly interested from John, apart from hearing of his issues that really change the market, make him stand up and get noted and notice, but also he's involved much with commercial life. What about, where is the office market at the moment? Do we need offices? Lucy alluded to the changing work-life balance. How is that going to affect the office market? And what about retail? Is there any hope there? And also, I know he's done some work on co-location, which we discussed a little bit earlier. Is that maybe an opportunity for some of us to get into? So anyway, John, perhaps that's enough pre-material. You get on, let's hear what you've got to say. Thank you.
Great, thank you, Jeremy. I'll give you a quick download on what's happening in the commercial market. I'm not going to talk too much about the land side. Obviously, there isn't as much greenfield land in this market as there is on the residential side. And also, we just don't have the same evidence yet because, we have a few, even in a market like London, you have a few hundred commercial transactions a year, at least of any reasonable size. So it's a completely different market in terms of volume to residential. But just quickly, if you look at what's happening generally across the board, debt margins for what we would call non-core property, so anything that isn't sort of let on a long lease to a good company, debt margins have gone up for that by about 2 percentage points. There isn't really that much sign of stress so far in the market because lenders are generally showing forbearance. We are seeing some deals going through, particularly in areas like logistics, some elements of the kind of alternative residential market, if you will, and also some core London deals as well at pre-COVID levels. But there has been a definite fallback in deal velocity across the commercial market with a lot of deals on hold. We don't know yet whether these are actually dead or whether they're going to continue. But certainly the volumes we've seen in terms of transactions in Q2 will be the lowest we've got on our records. And our records go back to the late 80s, early 90s. We're definitely seeing investors pivoting towards what we call long income products. So that would be, classically a property let on a 25-year lease on an index-linked basis to fixed uplift basis, that is to supermarkets or major corporates and so on. The public sector typically, logistics, especially urban logistics, are massively in demand. Companies like Amazon have been very busy, still taking logistics space throughout the lockdown period, and certainly alternatives are still very much in vogue, and I would include data centers as an area that's very much in demand, but also the whole kind of corporate residential area, the private rented sector, so large scale construction of units to rent. corporates are under duress, and many are looking at whether they could sell their property on a sale and leaseback type basis to try and generate cash, and that could provide investors with a big new wave of long income opportunities. And that's true for local authorities as well. There's lots of private equity money in the market, especially American private equity, looking for distress, particularly in the retail market. They've been looking at the retail market for some time now, but the values haven't got quite to where they want them to be. They still think they're a bit inflated compared to the real value. But, I think over the next, certainly in 2021, we'll start to see that really crystallizing. And of course, we've got even lower for longer interest rates, which is going to have some interesting impacts on the market. So what I'll do is just quickly run through each sector and then talk about what I think this means for the market overall. First of all, offices. Everyone's talking. This is a sector that everyone's talking about. There's a lot of debate around this. Obviously, we've had the world's largest ever experiment in home working. Many companies think it has worked quite well. You do increasingly hear concerns that productivity may have dropped back. Whatever happens, I certainly think we're going to see more flexible working practices going forward. Probably people going to the office, 3 or 4 days a week, working at home 1 or 2 days a week. That does mean that we've seen these processes for some time, and that the COVID epidemic really just accelerates some of them. And that's really companies noting that if people are working at home or working at client sites or whatever, they actually need less space. They can work more flexibly, and you will probably see, the demands from individual companies for HQ type offices reducing in size overall for each requirement, that is. But actually, our view is that this also, if you're going to have lots of people working in a fairly diffuse way around the country, it emphasises the need for that central collaboration space, that central hub. And that will make places like London and other hubs even more important to companies. And within that, there'll be much more emphasis perhaps on meeting rooms, collaboration space, amenities, cafes and so on, and wellness. We will see the office change as a result of this. But as well as that, we could see a resurgence of business parks, because it would be easier people were keener on getting places by car. And also perhaps more club type, flexible type facilities, perhaps not co-working given the proximity of people to each other, but certainly more serviced office type facilities in other locations. But this does mean that commercial property will probably change as an asset and become a bit more like running a business rather than just taking rent. Industrial logistics. This is obviously the sector that's very much in demand. Partly because it's done so well out of lockdown, with online retail really accelerating. The figures are really quite staggering. And it's really started to penetrate into older groups, for example, who haven't previously been so keen on using credit cards online or getting home deliveries. And that's going to carry on. And we've city logistics has been really strong in the southeast, partly because so much industrial land was lost to residential over the last few years. And there's a real shortage of industrial land in the southeast. That's not, and what you're also seeing as a result of that, as Jeremy mentioned, is increasing co-location. So, we are seeing people thinking about how they can introduce logistics into residential schemes, how they can repurpose struggling retail schemes, bringing logistics into it. But there are also tensions in this marketplace. We're seeing companies thinking about how they can rework their supply chain, thinking about what trade tensions mean for their supply chain, increasing inventories, which obviously helps the warehousing side, but also introducing automation and robotics to try and gain better efficiencies, and also to guard against any kind of post-Brexit labour concerns. Finally, retail. Retail has really been in trouble for several years for obvious reasons. Although there are limits to home delivery with pollution and congestion, and our belief is that means that we'll see click and collect and kind of bricks and mortar stores, either from the convenience or the destination point, becoming more important for that reason. The sector's under particular stress because of some of the way that some of companies have not been paying rent during this period. That was already an issue with the rise of the CVA. But certainly you can see chinks of light in this sector. At the one end, more people working at home means perhaps a revival of certain high streets, a local renaissance, as I put it there. If more people are working in affluent commuter towns around London, for example, then there'll be more demand for local services, local food and beverage opportunities, and so on. And at the other end, we suspect that once we get over the issues around COVID, we will see destination retail, and I mean By that I mean, the shopping centres that offer an experience as well as just a place to go shopping. They will retain, they will get stronger and stronger. And it's that middle ground, the sort of secondary shopping centres, that will carry on struggling. Although we are seeing across this sector a shift towards turnover rents.
John,
finally,
Are you just about wrapping up now? Because we're
I am now. Yeah, sorry. A lot to get through. Just a few ideas on what would be the more resilient and less resilient sectors. I've talked about all of this before. You can see that on the left-hand side. I think some of the areas that will struggle more, that middle ground of retail, offices that have a value-add component, perhaps student accommodation, and those co-working and co-living sectors. Although we are talking there about the short term, there's plenty of subsectors within there that would do well. And as usual, it's all very dependent on geography, subsector and asset. So thank you, and sorry for going on a little bit too long.
No, it's all very brilliant. And then I think, it showed me that we could probably do something alone on that. There's just so many issues, that not just for commercial, but now, as you say, merging with other sectors. So yeah, hopefully 1 or 2 questions on that too. Apologies for keeping you waiting there. Rupert's been very patient there. He's still there, fortunately. Now, Rupert Driver is a senior director at CBRE, specialising in residential valuation in that team, based in London, and in the valuation of residential mixed-use developments and strategic housing sites. Rupert's work includes loan security valuations on behalf of banks, investors, and financial institutions, and equity funds in particular. And from my perspective, I'm interested from Rupert to find out about the lender stance. What's the change? What are lenders telling him? Does he find his figures are making or following the market? And what about these material uncertainty clauses? How long are they going to be with us? And how are you managing without so much data these days to really hit on the valuations? I think a lot of people have been saying that to me in my working life recently, and certainly one of the 2 questions I've seen. So over to you, Rupert. Let's hear it from you.
That's great. Thank you very much, Jeremy, for the introduction. It'd be my pleasure to answer those questions. Apologies for the headphones. I know I look like a pilot at the moment, but a few technical issues. I'm just going to share my screen and then hopefully rattle through some slides which will answer those questions for you. Just bear me 1 second. Okay, great. So there's obviously a lot of ground to cover, but the 3 things I really wanted to focus on today very quickly was the use of market uncertainty clauses in valuations. The sensitivities, I think it was discussed in the introduction to land values by, it only takes a very small change to some of the key inputs to have a disproportionate effect on underlying land values, and how as valuers we look at that, and generally just a bit about our outlook and market considerations, and particularly in a market where there are limited transactional sales, what are the key issues that we look for. So in terms of the valuation market uncertainty clause, this is something that's in all formal valuations, has been in place since the onset of COVID-19. I'm just going to quickly paraphrase through some of the key points within this clause. So obviously, real estate markets generally are experiencing lower levels of transactional activity and liquidity. The data valuations currently, there's a shortage of market evidence for comparison purposes to inform our opinions of value. Consequently, less certainty and a higher degree of caution should be attached to our valuations than would normally be the case. So for the avoidance of doubt, the inclusion of the material valuation uncertainty clause does not mean that valuations cannot be relied upon. Rather, it's just a declaration that's there to ensure transparency to this fact that in the current extraordinary circumstances, less certainty can be attached to the valuations than would otherwise be the case. In the case of development valuations, we draw attention to the fact that in normal conditions, residual method evaluations are sensitive to key changes in inputs, with only small changes in variables having a disproportionate effect. So that is the current wording which is being adopted by all of the valuation houses. In summary, the use of the material uncertainty clause is an RICS requirement. So it's a consistent and joined up approach across the valuation industry. A leaders forum has been set up, which is governed by the RICS with representatives from the major valuation houses and some of the accountancy firms. So the wording and its use is controlled. So if you're getting a valuation from CBRE, from Jones Lang, or from Savills or Knight Frank, it's going to contain exactly the same wording. It's there to serve as a precaution. It's not to invalidate a valuation. Valuations can still be relied upon, and the forum meets on a regular basis to discuss whether the wording should be changed or in fact whether it's still necessary. There have been some exclusions so far. So because there's been more transactional activity seen in the industrial and logistics centres, it doesn't apply to that. Likewise, in the residential on the build to rent side, certainly for institutional grade properties, the clause isn't being used. Likewise for food stores and some specialist residential lets to registered providers. So it's being monitored on a very regular basis, and watch this space as to whether it comes out on development land. But I think the consensus at the moment is there is still uncertainty and it's appropriate to be used. So moving on to my next slide, I just wanted to talk about the sensitivities, and Jeremy said in his introduction, do we make the market? No, we don't as valuers. We don't tell the market where value should be. Our job is to read the market, and certainly to our banking clients, highlight the opportunities, but also highlight the key risks. I've just put together here a very simple residual appraisal. This is a sort of a sample low density housing scheme where we've got 200 houses, and with the assumptions I've made, which hopefully you consider to be reasonable, it's producing a land value of about 17.6 million. So the land value here as a percentage of the GDV is about 23%. So with all things being equal, if you were to change flex the gross development values, you can see here that for every 1% of the GDV reduction, it's having effectively a 3% fall on the land value. So from a stress testing perspective, if you were to fix the land value at 17.6 million, if you had a 7.5% fall in GDV, you would effectively reduce your profit by about 50%. So it shows how land is highly leveraged, and the sensitivities to GDV. And in terms of how the maths work, the higher the profit amounts, the more sensitive the underlying land value will be to movements in GDV. So that ratio of 1 to 3 would increase. You know, obviously you can't just look at gross development values in isolation. And then to further underpin the sensitivities, I've run another scenario where GDVs fall by a percentage point and costs inflate by a percentage point. And you can see here that you get the ratio of a fall of, for every 1% you lose on GDV and 1% on costs, you get a 4.5% fall in land value. So that's just really to demonstrate how the maths work. And I'm sure everyone here is, you know, knows that the classic line that valuation is an art and not a science, but it's just to demonstrate the sensitivities. And certainly when we are undertaking valuations for the lending community, you know, we will very closely look at things like LTVs, the maturity date of the loan. And in our stress testing, we will look at the impact that changes to finance rates have, profit margins, construction cost inflation, and time delay risks. GDV is obviously very important, as highlighted previously, and also very importantly is the sales volumes. You know, are we continuing to see sales off plan? What's the sales velocity post completion? Impact of demand from domestic buyers, and where applicable, the overseas markets. But the key thing for us from a valuation perspective is that we run the maths with inputs and assumptions which we think are robust, but it's critical that we benchmark everything just to make sure it's in line with the market. So final slide, which I'll quickly rattle through. So when we're in a market where there isn't the depth of transactional evidence, and we're mindful that there's been a material change to the market, and perhaps the most available comparable evidence is starting to look historic. What do we look for as valuers? So, we have the benefit of the material uncertainty clause to just, hammer home those points I've discussed, but we will, as valuers, we will speak to our land agents. We gauge market sentiments. What is the status of any live transactions? So certainly, as we've gone into COVID, there are a number of transactions which were advanced before the pandemic hit. We've been tracking and monitoring those. We've been looking at changes in sentiments in the market in terms of deals that have come to the market since the pandemic has started. Where is the activity? Where is the inactivity? Who are the key players? As valuers, our job is impossible if we don't understand who in the market is the prospective buyer. The whole valuation piece just doesn't stack up. We will look at house price data, sales volumes, certainly real-time data from our sales agents. We're very lucky that we work in a collaborative environment where we've got sales agents, people buying and selling schemes that give us live data. We also do look at indices. Obviously, there's a bit of a lag with some of the indices, and we're also mindful as with such a low volume of house sales at the moment, it has the ability to skew some of that indices. We look at the macroeconomic outlook and forecasts. Where do we think GDP is going? Unemployment figures. We look to other asset classes like the equities market, the bond market. What does that suggest in terms of the repricing of risk? Clearly, for developments, interest rates and the lending market is key, particularly for the SME market. We have seen, the clearing banks largely protecting current positions and looking after their clients, probably with less appetite for new work. We have seen the debt funds come to the fore, and we're seeing some debt more expensive. So we do follow that very closely with our capital markets and our advisory teams there, just to understand again, how easy or how difficult is it to source debt.
Yep.
And then likewise, in terms of exit values, we are looking at what's happening in the mortgage market.
Okay.
Then obviously other things. I'm probably coming to the end, but happy to talk about it. But we look at the supply chain, we look at the planning position, we focus on the location and the flight to quality in these times, and of course exit strategy. Not everything is built for sales exits. We have seen strong demand on the rental side with if the economics stack up, people looking for land for forward funding opportunities, and finally, social change and new trends post pandemic. So the provision of space for home working, outside space, and sustainability, all things that have come to the fore, which are now important. And when we're looking at schemes, even if they're consented, just to make sure that they are aligned with where market demand is.
Okay, that's really good. I was particularly interested in that slide you mentioned, or that point you made about the reductions in GDV, and I'm sure it's close to a lot of people's homes at the moment. But right, let's move on to some questions. We did start a little bit later. We've got time for a few questions which have come in earlier. Perhaps we go back to Lucy first of all. Can I ask you one question that came in terms of supply of new homes, Lucy? What did you think that the 10 years will be more or less resilient in the next few years? Where do you see things moving?
Yeah, really good question. I think. Can you hear me all right, Jeremy? Yeah. So the 10 years that are going to be able to continue and weather this better are the affordable sector that is grant funded, because that by its nature ought to be counter-cyclical and able to continue because it's not reliant on the market. What we are seeing is that the private sales obviously really do, and the private sector depends on sort of that sentiment in the market, and how accessible mortgages are, help to buy is obviously supporting that sector as well. So at the moment we're seeing kind of this post-COVID bounce, but the question is how long that survives for and whether it's continued. So the other side, the further tenure is the build to rent side, and that's been growing. And we've last year built around 11,500 build to rent homes. It has the opportunity to grow even faster if the market struggles more. At the moment, we're seeing it, affected in the same way, in that the slowdown had to happen because construction simply couldn't occur. But it could grow much faster coming out of this if private sales are slower. So you have a bit of a balance there, but it will be a payoff in terms of what the house builders are prepared to do in terms of whether they're prepared to change tenure and negotiate with the build-to-rent developers to make that happen, or funders, should I say.
Okay, hopefully we've got time for one or two more. See that dreaded image of Alex comes on the screen and cuts us all off and we have to disappear. But before that, just need to ask if we can get one each in for John and Rupert. John, you touched on a little bit about co-location. I think that may be of broader interest to more people in the audience today. I noticed recently there was a case of development, a shopping centre in Maidenhead where it had rather become obsolete, too many department stores or larger, I think it was called the Nicholson Centre. And I wondered if you felt that might be a model for others, because I think a lot of the space was going into boutique shops, retirement housing and flats and social and private sale. And whether we would start to see some of these shopping centres which have been so iconic in the past and so memorable for so many of us, and then just changing their patterns, as we heard in the Oak North presentation, much the same. Do you see that's going to happen all over, or is it just certain markets?
Well, yeah, absolutely. I mean, one of the big themes for the next few years will be the reinvention of retail, and whether that's the high street, whether we see co-working or serviced offices coming into the high street, because more people want to work close to their home, especially people like me who've got a young family around making a lot of noise. But also, shopping centres, retail parks. We're going to see, especially I think in the southeast, logistics become a big part of that. So we've already seen a number of shopping centres bought around, out of London really, that have been converted to logistics space, because city logistics space is in such short supply. We'll see, increasing use for electric vehicle charging in those sorts of locations. We'll see more residential. I mean, I think it's Land Securities who are converting a lot of their kind of zone 2, zone 3 shopping centres into residential. We'll probably see more kind of experience entertainment uses. I mean, this was really the case before COVID, and maybe it'll take a while for it to rebirth. But the kind of urban golf and the escape rooms and that sort of thing. There'll be more of that going on. But the main theme I think will be retail being repositioned, perhaps less of it focused down around kind of certain key brands, with a focus perhaps on click and collect, backed up with some on-site logistics space as well.
Okay, interesting. Thank you. I don't know if we've got time for one quick one for Rupert. You were talking about these material market uncertainty clauses, but can we really rely on them, Rupert? Would you say that's fair, as from a lender perspective as well as a buyer perspective? What's your take on that?
Yeah, I think the key thing from a valuation perspective is that they're just there to point out the obvious, that we're in an environment where there's been uncertain times, and just simply less weight can be attached to our opinion than previously. It's not there to say that that values are being suspended pre-COVID. And we are doing our very best to look at other data points in the absence of land sales to form an opinion. But clearly, at any other time, that opinion is more subjective, and we are just advising, particularly our the lending community, that the valuation should perhaps be reviewed more regularly.
Okay, that's reasonable. The dreaded image has appeared. Alex is there. He's going to cut us off in our prime. Or have we got time for any more, Alex? How are we doing?
Well, I've come with my my dreaded screen to drop in a couple other questions that have appeared in the Q&A. So if everyone would just hold for a few more minutes, we'll just go through some of the questions from our audience.
For other people, Alex, is that if people
say it again?
Will the notes be available for other people afterwards if they want anything?
Whilst they're all on screen, I'm going to ask, put a little bit of pressure on all of our speakers to see if we could share some slides, because it would be nice to be able to share them. There were some great stats from all of you there as well that we would love to share. So we'll arrange that with you guys afterwards, and we'll send out an email after the session. There's three, a good point, Jeremy. There is 3 questions that came in. So one of them was for Rupert in terms of, do you have a view on material and labour cost changes for the rest of 2020, particularly core items such as steel and timber? Any views there in terms of how a valuer is perceiving material cost?
Yeah, sure. So again, as a valuer, I'm not a cost expert. But what we will seek to do in our valuations is collaborate with our building consultancy colleagues who are live and have their finger on the pulse in terms of any issues around supply chain, cost inflation, cost delays, and find out what's happening in the market. And we won't just rely on things like BCIS data or SPONs. We will be going to the coalface by speaking to our building consultancy clients who are live on sites, and it's live data. As a firm, we are constantly in contact with the specialists across all the areas of the residual appraisal, whether it's sales advice, building consultancy advice, funding advice, planning advice, just to make sure that we are trying to capture what is happening on the ground.
Rupert, is there anything that's made the hairs in the back of your neck stand up, thinking if that happens, that is going to have a big dent? Is there anything you've heard from your perspective, from your colleagues, in terms of material costs?
In terms of cost inflation, we have already seen quite considerable cost inflation over the last 5 or 6 years, and I think that the data would have suggested prior to COVID-19 that I think that cost inflation was starting to abate. Clearly, the initial impact that the pandemic has been less on costs, but the physical impact of development sites having to be closed because of social distancing measures. That's been less of an impact on strategic land, where civil engineering works have been able to continue because the workers are at less close proximity. But certainly in the urban apartment sites, those have been closed for some while, and we've seen an easing. But clearly there may be some short-term cost inflation whilst the receipt of materials coming in from overseas are being slowed down by just the practical changes. But what we might see going forward is the fact that the construction industry slowed. We might see contractors becoming more competitive again with their tenders to keep their businesses going. So whilst it's probably inevitable that we'll see some short-term cost inflation and some delays over construction periods, one of the results may be that we do see some easing of costs as I say, as contractors are forced to become more competitive.
Okay, I don't know if it is because of the headphones and the airline pilots, but I do feel remarkably reassured by what you're saying, just purely because of the sound of the of your audio. Either that, or it sounds like you're on the radio, which is normally Jeremy's thing. So I do feel quite reassured by what you've been saying there, of course, by John and Lucy as well. But I do like the audio. Last question before we round up, and maybe John, this is one for you with a little bit of a lean in from Lucy. In terms of social change and the new trends, John, you touched a little bit about sort of leisure side in terms of the way that we can interact with each other, become destination retail. Tony Lorenz, a good friend of the network, who said last year at our conference that the person who comes up with a solution for the big shopping boxes will be the new Bill Gates. What do you think, and this is from Beth Fisher, what do you think are trends that are here to stay as a result of the exercise we've just done through the social experiment for the last 4 months, not to downplay it, and what do you think will ease off and kind of get back to normal from a sort of commercial and residential perspective?
That's a big question. Well, first of all, I think the office has got a future. People will go back to work, just probably not quite in the same way as before. And I don't think it's a case of so much going back to normal as a case of we've just seen we will see about 5 year or 10 years worth of changes overnight in terms of some of the acceleration we've seen over the past few weeks, whether that's about the online shopping becoming mainstream for everyone, whether it's about home working becoming mainstream for everyone, whether it's about retail reinvention. All these trends were already there. It's just that COVID has just accelerated everything, really. It's still quite difficult to separate what's permanent from temporary. I tend to think that the world will probably end up looking not as different as we might think as before, just with a bit more of an emphasis on the local and a bit more of an emphasis on home working, really. I think some of the people who are talking about drastic changes are probably overstating the case, but we have seen acceleration of existing shifts.
Is it very much the same in the residential side as well? If people were thinking about moving out of London, more rural property or somewhere with more outside space further from work, then this is accentuating their kind of want to do so. And so we're seeing that drive out. It's something that happens over time to various groups of people as you have family and want that kind of more less London vibrant, crazy busy time. But there is still a demand for that, and younger people particularly will still thrive for that. So it's not going away. It's a short-term thing. You know, obviously we're seeing more demand for flats with or properties with gardens or outside space at the moment, rather than those flats that don't have any outside space. Mm-hmm. But affordability pressures still mean that they will be in demand to some degree, and we still need more homes.
Wonderful. Thank you, John. Thank you, Lucy. I do hope there's one trend that is here to stay, which is some good, colourful bunting in the background of video conferences as well. I do think I said to you the other day in our pre-event chat, I do think it helps bring a little bit of spirit to often quite serious topics as well. Jeremy, incredibly well delivered, and thank you for hosting. John, Rupert, and Lucy, incredible insights. Thank you for spending the time to put something together for us and for our audiences. The SMEs out there are very optimistic, but it's important we all get perspective as much as possible so that we can make some sound decisions for our businesses, for our practices, for the benefits of our team, and obviously for the benefit of good quality property development. That brings us to the end of the formal session today. As I said, we always leave Remo open for about an hour to continue networking. So when I go out of presentation mode now, and all of our speakers disappear from our virtual floor, all the tables will still be open. They'll be available for up to an hour. Maybe if someone hasn't got a dash off, we could have a couple of questions sort of one-on-one with John, Lucy, Rupert, or Jeremy. But thank you very much for attending. Just a quick reminder to everyone who is with us, please do, if you are a TrustedLand member, start to get your nominations in, or give your partner or significant other a nudge to say, I think there's a nomination that I should be mentioned for. Would you mind going to the honors if it feels too tacky to go and enter your own name or company into the fields? But that is open now up until the 23rd of July. And of course, we'll get ready to an amazing event with Tom Bloxham from Urban Splash, John Birds from Don't PLC, who'll be joining us to deliver the awards on the 12th of August. Thank you very much for everyone who participated today. Thank you everyone who attended, and we look forward to a bit of networking. Thanks all.
Thank you, Alex. Thanks for inviting us.